Do the headlines about falling markets make your stomach churn? You're not alone. It's natural to feel anxious when stock prices plummet. But what if those dips, those moments of market fear, were actually opportunities in disguise? What if downturns, instead of signaling danger, were actually paving the way for future growth? This isn't about wishful thinking. It's about understanding how markets work. Downturns are inevitable, like a summer thunderstorm. But just as storms nourish the earth for future growth, market dips can create fertile ground for future returns. Financial crises, like those in 2008 and 2020, are rarely caused by a single event. Instead, they're often the result of a complex web of factors: excessive debt, risky lending practices, speculative bubbles, and sometimes unpredictable shocks that no one saw coming. These ingredients can simmer beneath the surface for years, quietly building up pressure in the financial system. When the tipping point is reached, the result is often a sudden and dramatic downturn that catches even seasoned investors off guard. Unexpected events like the COVID-19 pandemic can act as catalysts, triggering panic and uncertainty across global markets. Businesses shutter overnight, economies grind to a halt, and investors scramble to make sense of the chaos. In these moments, fear takes over. Investors, worried about losing their savings, rush to sell their assets. This wave of selling drives prices down even further, creating a self-reinforcing cycle of anxiety and loss. History is full of examples. Take the dot-com bubble of the late 1990s, when excitement over the internet's potential led to a frenzy of investment in tech startups. Investors poured billions into internet companies, many of which had little more than a promising idea and a catchy name. Business plans were hastily written, and profits were often a distant dream. When reality set in and these companies failed to deliver, the bubble burst. The tech-heavy Nasdaq index lost nearly 80% of its value, wiping out fortunes and shaking faith in the market. These painful episodes remind us that markets are driven not just by numbers, but by human emotions: hope, fear, and sometimes unchecked euphoria. Understanding these storms is the first step to weathering them. The good news? Markets are resilient. Despite numerous crashes, wars, and recessions, the stock market has consistently trended upwards over the long term. The 2008 financial crisis, while terrifying, was followed by the longest bull market in history. This isn't to say that every downturn is a guaranteed buying opportunity, but history shows us that markets have an incredible ability to recover and reach new heights. Understanding this historical context can help you stay calm and focus on the long term. Imagine your favorite grocery store having a massive sale. Everything is 50% off. Do you panic and empty your bank account on day one? Or do you see it as a chance to stock up on quality items at a discount? Investing during a downturn is similar. Stock prices are lower, which means you're essentially buying pieces of great companies at a discount. This doesn't mean blindly buying everything. It means taking advantage of the opportunity to accumulate shares of strong businesses at lower prices. Trying to time the market perfectly, buying at the absolute bottom and selling at the peak, is incredibly difficult, even for professionals. Instead of trying to predict the unpredictable, focus on time in the market, not timing the market. Consistently investing over time, regardless of market fluctuations, allows you to ride out the downturns and benefit from the inevitable recoveries. And remember, the goal is not to make a quick buck, but to build wealth gradually over the long term. So, how do you invest wisely when the market feels like a roller coaster? It's a question every investor faces at some point, whether you're just starting out or you've been in the game for years. The truth is, market volatility is a normal part of investing, but it can feel overwhelming when you see your portfolio value swing up and down. The key is to approach these moments with a clear head and a solid strategy. Well, here's a practical guide. First, stay calm. It's natural to feel anxious when you see red numbers and negative headlines, but reacting emotionally can do more harm than good. Take a deep breath and remind yourself that downturns are temporary, and markets have always recovered over time. Don't let emotions dictate your investment decisions. Fear and panic usually lead to costly mistakes. When you act out of fear, you might sell at the worst possible time, locking in losses that could have been avoided. Instead, try to separate your feelings from your financial choices. Remember, investing is a long-term journey, not a sprint. Next, Stick to your plan. If you've created a thoughtful investment strategy based on your goals, risk tolerance, and time horizon, trust it. Don't abandon your plan just because the market is turbulent. In fact, these are the times when your plan matters most. Having a well-defined investment plan really helps you stay disciplined and avoid those impulsive actions. Keep investing. Consistency is powerful. By continuing to invest regularly, you take advantage of dollar-cost averaging, which means you buy more shares when prices are low and fewer when prices are high. Over time, this can help smooth out the impact of volatility. If you're investing regularly, don't stop now. Automatic contributions to your investment accounts can help you stay on track, even when the news is scary. Remember, some of the best investment opportunities arise during downturns, when others are too afraid to act. Just remember the supermarket sale analogy. Downturns are actually opportunities to buy at lower prices. Think of it like shopping for your favorite products when they're on sale. Would you stop buying just because prices dropped? Of course not. The same logic applies to quality investments. You want to look for companies with strong fundamentals like healthy balance sheets, solid management, and a history of profitability. Focus on businesses that can weather economic storms and come out stronger on the other side. These are the companies most likely to reward patient investors. Also, maintain your emergency savings. Before you invest more, make sure you have enough set aside to cover unexpected expenses. This safety net is crucial, especially during uncertain times. A healthy emergency fund gives you a financial cushion, which reduces the urge to sell investments at a loss if unexpected expenses pop up. Rebalance your portfolio too. Over time, market swings can throw your asset allocation out of balance, exposing you to more risk than you intended. Downturns can disrupt your asset allocation, so consider rebalancing by selling some assets that have held up well and buying more of those that have declined. This disciplined approach helps you buy low and sell high, which is the essence of successful investing. Don't forget to review your goals and risk tolerance as your life changes too. Use this time to deepen your understanding of investing. Read books, take online courses, or listen to podcasts. The more you know, the better equipped you'll be to make smart decisions, no matter what the market is doing. The more you learn, the more confident you'll become. Remember, successful investing isn't about avoiding downturns. It's about navigating them with patience, discipline, and knowledge. Stick to your plan, keep learning, and trust the process. Over time, you'll be glad you did. Just as there are smart moves to make during a market downturn, there are also some common and costly mistakes that can seriously set you back if you're not careful. In times of uncertainty, emotions can run high, and it's easy to let fear or anxiety drive your decisions. But being aware of these pitfalls and knowing how to avoid them can make all the difference in protecting your financial future. One of the biggest mistakes investors make is panic selling. When markets drop, it's natural to feel worried, but selling your investments out of fear often means you're locking in your losses. Historically, markets have always recovered over time, and those who sell in a panic often miss out on the rebound. Instead of reacting emotionally, take a step back and remind yourself of your long-term goals. Another common trap is trying to time the bottom of the market. It's tempting to think you can sell now and buy back in at the perfect moment, but the reality is that even professional investors struggle to predict market bottoms with any consistency. Waiting for the right time often leads to missed opportunities and can leave you on the sidelines as the market recovers. Predicting the exact bottom of the market is nearly impossible, and trying to do so can lead to frustration and poor decisions. Instead of chasing the perfect entry or exit point, focus on a disciplined investment approach. Remember, investing is a marathon, not a sprint. Don't take excessive risks in hopes of making up for losses quickly. Chasing speculative investments or hot tips can be especially dangerous during volatile times. It's easy to be lured by promises of quick gains, but these often come with high risks and the potential for even bigger losses. Instead, stick to a well-thought-out plan and avoid making impulsive decisions based on short-term market movements. It's far better to focus on sound, long-term investments that align with your goals and risk tolerance. Diversification and patience are your best allies. And remember, don't stop investing altogether just because the market is down. Halting your investments during a downturn might feel safe, but it can actually mean missing out on some of the best opportunities for growth when the market rebounds. By continuing to invest regularly, You can take advantage of lower prices and position yourself for future gains. Stay the course even when it feels uncomfortable. Another mistake to avoid is following the crowd. Herd mentality, buying or selling just because everyone else is, can lead you astray. The most successful investors stick to their own plan and make decisions based on careful analysis, not on what others are doing. And finally, resist the urge to check your investments too often. Constantly monitoring your portfolio during periods of volatility can amplify your anxiety and may tempt you to make rash decisions. Remember, short-term market swings are normal, and obsessing over every dip or headline can be exhausting. Instead, trust your strategy and give your investments time to grow. By focusing on the long term, staying disciplined, and avoiding these common mistakes, you'll be much better positioned to weather any market storm and achieve your financial goals. Investing always involves some level of risk, but understanding that risk is just an inherent part of the process and that downturns are totally normal can help you approach investing with a calmer, more rational mindset. Remember, the goal isn't to avoid risk entirely, but to manage it effectively. By diversifying your investments, staying disciplined, and focusing on the long term, you can navigate market turbulence and build wealth over time. Investing is a marathon, not a sprint. There will be periods of exhilarating highs and, some gut-wrenching lows. But by staying patient, sticking to your plan, and remembering the lessons of history, you can turn market downturns from sources of fear into opportunities for long-term growth. Remember, the greatest wealth-building stories are often written during times of uncertainty and change. If you found this video helpful, don't forget to like, share, and subscribe for more investing tips. Your support helps us grow and bring you even more valuable content.